The biggest tech companies and the biggest AI companies in the world are literally right now carrying out a fraud and a scam, the scale of which has never really been seen before in human history. And it is, though, a similar story, almost identical to what we saw happen about 25 years ago with the Enron fraud of fake revenue, fake value, and hype into a new technology and wider asset bubble that popped and took down the entire economy with it. Now, the only major difference between what we're seeing right now and what happened with Enron, well, Enron only cost those directly exposed to it about $74 billion, whereas this AI scam of fake revenue and fake value is set to cost investors as much as $20 trillion, about 270 times as much. And in this video, I'll explain exactly what's going on, why it's so important, and what you need to know so you don't get caught up in this massive scam. Now, AI has been getting insanely hyped over the last couple of years, leading to one of the most overvalued markets in history, and that really isn't hyperbole. This graph here is the Shiller PE ratio, which basically measures trailing profits for the S&P 500 over the last decade versus the valuation of the S&P 500 itself. So the higher this line is along these points, that's how overvalued the market is. And you can see over the last 130, 40, 50 years even, it's on average been sat at around 10 to 20 mark, except for the last 20 years. And in particular right now, where it sits at about 39.5, the second highest it's literally ever been in history. Now, it's also worth noting that literally every single time the Shiller PE ratio has been higher than 30, there has been a market correction, a market crash, and a recession to follow, because this is just a brilliant index of the sign of a bubble. It's an overvalued market. And right now, again, the Shiller PE ratio is at 39.5, the second highest in history. The only time it's ever been higher than that actually was during the dot-com bubble in the late 90s and the early 2000s, which funnily enough is the exact same time that Enron was at its peak market cap right before it collapsed and was exposed as a scam as well, but more on that later. Now again, it won't surprise you to hear this, but the overvalued nature of the S&P 500 right now is massively driven by the overvalued nature of this AI hype as well. Here is a look at the valuation of Nvidia over the last couple of years. And you take a look at a company like this, and their increase in value does make sense to an extent. Here are their earnings per share at the top here over the last few years. 10 cents a share going up to 40 cents a share in 2022 when AI started, and then the boom takes off and their earnings per share does skyrocket. But the other thing that you notice is their PE ratio is absolutely monstrous, currently sitting at above 50, whereas in reality it should be sitting at around about 20 for a normal company and 30 for a high growth company when taking a look at historical averages. A PE ratio of 50 means that it will take you 50 years to get your investment returned to you if you bought into Nvidia today based on the profits they're currently making. A 50-year time horizon is absolutely insane for any investment, and no real investor is actually taking that gamble. Now, the important thing I want to cover here is what's been getting a lot of the media attention over the last couple of weeks and causing so much worry at the moment, and it's this idea that the revenues and the profits from lots of these AI companies, well, they actually might be fake and they don't really exist. And it all comes down to this term of circular deals or circular investments that we're seeing being thrown around a lot right now. Now, the two biggest players here with these circular deals are OpenAI and Nvidia. And the basics behind this idea is take company A, they invest into company B. Company B then use that new money in investment from company A to buy stuff from company A. And so now company B is worth more money because they've got this newfound investor and a load of extra cash. And then company A is worth more money because all that extra cash in company B is just turning into revenue for company A. But in reality, no money is actually changed between either of these companies and nothing of value has been created. There are just being numbers pushed around on balance sheets. This is actually really similar to this old economics joke, which explains perfectly the problem with circular investments, but it actually comes from inflated GDP figures and something often called the broken window fallacy. Now, two economists are walking through a field when one of them noticed a cow pat next to the path. The first economist says to the second one, "I'll pay you $100 to eat that cow pat," and the second economist goes ahead and eats it. They then continue walking along until this time the second economist sees a cow pat along the path first and says to the first economist, I'll pay you $100 to eat that cow pat, and the first economist goes ahead and eats it. Now both economists feel far worse off than they did before, both have the exact same amount of cash in their wallets as before as well, so the first economist states that these transactions didn't actually make either of them better off. But then the second economist jumps in and says that at least they added $200 to the country's GDP figures. Now, funnily enough, that's almost exactly what is going on with the circular investments between AI companies right now. And to explain this, we're going to take a look at this new deal that came out about a week ago between OpenAI and AMD, two of the biggest players in this AI bubble. Now, OpenAI announced that they're going to buy $50 billion worth of AI chips from AMD, who compete with Nvidia. And AMD is going to invest into OpenAI and become a 10% shareholder of what is currently a $500 billion company. So out of this deal, AMD gets an extra $50 billion in revenue from the GPUs that OpenAI will buy, and their market cap jumps by $60 billion actually on this news, on the announcement. And then AMD used that now larger market cap to fund the debt to buy up 10% of the shares of OpenAI, in the process giving that $50 billion right back to AI. And OpenAI, on the news of this new deal, increased their valuation on the private market, so the next time they raise capital, they'll be worth, say, $600 billion instead of $500 billion. Now, in theory, $50 billion has gone from one of these companies to the other, but then it's just gone straight back to the original company. Neither company is actually better off than before. Neither company has more money in their bank. All they have is a spreadsheet that says $50 billion in the box for revenue and an extra $50 billion on the assets of each company as well. Yet both the companies' valuations have gone up by more than $50 billion. Just like that joke with those two economists, neither party's actually more valuable. They've just passed money amongst themselves, but the statistic that everyone is watching, in this case revenue, has gone up. And so the onlookers are celebrating, they're buying into these companies, and they're inflating the value of their stocks. Now, these circular deals are absolutely everywhere you look, and with AI in particular. Now, it's past the point where anyone can ignore them anymore because they present basically an existential threat to the stock markets right now. Now, what we're looking at here is actually a stock market index for the S&P 500 over the last few years since this AI bubble started in around about 2022. And as you can see very clearly, the index was sat at around 3,500 3 years ago. Now it's sitting almost twice that at 6,700. What this really means is that since this AI bubble began, the S&P 500 has risen in value by about 25 trillion US dollars. Now, if the valuation of the market had remained the same over those last 3 years, however, and if the Magnificent Seven hadn't been inflated in value to such a ridiculous degree, if a company only ever went up in value if their earnings increased, and by the same ratio, then the S&P 500 should have only increased in value by about $5 trillion. That means, in essence, the AI bubble has so far inflated the stock market by about $20 trillion, and it's now only really a matter of time until it all comes crashing down because suddenly investors are looking for the problems. And this actually is where things get scarily similar to the dot-com bubble 25 years ago, and more interestingly, the number one loser of the dot-com bubble, the $74 billion fraudulent company of Enron. Now, obviously, just buying into the index funds is actually a very dangerous strategy these days, considering how 35% of the S&P 500's value is just the so-called Magnificent Seven stocks, which are all boosting their revenue and valuations with these circular deals and investments. And that's one of the reasons why I'm so excited about this video's sponsor, the NAGA Group. They're a fintech company operating a social trading and investing ecosystem that merges their brokerage with social networking and digital payments. Most interesting to me, though, is the launch of NAGA One, coming in Q4 of 2025, a next-generation super app that unifies payments, investing, and trading with features like IBAN accounts, debit cards, bank transfers, and instant trading with crypto services, and the integration of AI to give their users real-time insights, personalized trading strategies, and a planned trading super assistant by 2026. Now, if you've ever been to a country like Thailand, you probably noticed how concentrated the app market is there, with one super app that has 100 different functionalities, and the convenience and the ease of use with that sort of super app is undeniable. But in the West, we're stuck with 100 different apps, 100 different accounts, 100 different passwords to remember, making everything more complicated. But what NAGA 1 is trying to do is to build out their fintech super app so their users simplify their lives with a one-stop shop app for everything finance. Now, NAGA Group just released their half-year report 2025, and despite a flat market with weaker trading volumes across the sector, they continue to grow their revenues, their net revenues, and their EBITDA, along with their brand awareness and their user base, showing that they're moving in the right direction, growing now at a healthy rate. Now, the NAGA Group are currently only valued at about 140 million euros, and in a space where competitors like Robinhood are worth more than $120 billion, there's a lot of room for upside. Of course, do your own due diligence, take a look at the company yourself before making any investment decision, but I'll leave some links down below in the description for you if you want to learn more about the NAGA Group. Now back to the video, and for the young ones watching like myself who were just 3 years old when the Enron scandal came to light and the company collapsed, and who don't really know the details of Enron, what was it all about and why is this AI bubble so similar? Well, in essence, Enron was a publicly traded company that was just insanely popular in the late 90s and the early 2000s, and they were involved in massively hyped up markets at the time, like broadband and telecoms and trading. But the core of the business was supposed to be energy trading and brokering. They claimed to be a new energy company, buying and selling contracts for energy, and as they grew, their model just moved beyond energy contracts as well. Now, the fraud of Enron was actually quite simple, but there were basically 3 different parts to it. The first, they used something called mark-to-market accounting, whereby they signed a long-term contract, but they booked all of the revenue and all of the expected profit of that contract straight away, even when they didn't actually know the revenue or the profits were going to come, and even if they did, or they might actually take literally decades to materialize. But on the company's books, the revenue and the profit was all instant. Now, funnily enough, they told the SEC that they were going to do this in 1991, and the SEC said it was fine. They had no issue with it at all, so it wasn't even hidden properly for about a decade until their collapse. The second big part of the fraud, though, was literally inventing fake revenue. They arranged transactions with other companies that produced no real economic profit. They were just passing paper money in between each other and inflating their revenues, inflating their profits further, making them seem more successful on paper to investors so that people bought into the stock and bought into the hype. Now, the third part of the fraud was specifically using smaller companies and subsidiaries called special purpose vehicles to hide debts and trick investors into thinking the company was again doing better than it actually was. Basically, they would create a smaller subsidiary company, stick say $1 billion worth of Enron's debt onto that company, and then a couple of assets as well, but then they would stop reporting that debt on Enron's balance sheet and pretend it didn't exist. Any revenues or assets from that smaller subsidiary company, though, well, they would be reported on Enron's balance sheet, so the company again looked to be much better off than it was. Now, you combine those 3 scams together, and Enron was able to basically invent a $74 billion company out of thin air. In fact, they claimed revenues of $139 billion in 2001 alone, making the company almost look like a good deal when valued at $74 billion. But of course, most of the business was all a fraud. So that price of $74 billion equated value to a mere fraction of what the market thought. And when this got exposed, the company collapsed. Now, this got so popular and so infamous that it's now been used to describe tricks of accounting to hide losses in debt and inflate revenue, profits, and assets in something called Enronomics. And while plenty of this was outright fraud and lies and illegal, actually a bunch of what Enron were doing was well publicized, the government knew about it, and it was perfectly legal. The SEC, again, were told by Enron about their mark-to-market accounting in 1991, literally 10 years before the company collapsed, and the SEC were fine with it. They just allowed it to happen, despite knowing it didn't really make any sense. And this is where the similarities between Enron and the AI bubble today get just too obvious to ignore. Now, the first similarity is obviously inflating revenue figures both amongst AI companies today and with Enron back 25 years ago, right? Nvidia announced they're investing $100 billion into OpenAI, and as part of that investment, OpenAI have to spend that $100 billion buying graphic cards from Nvidia. So Nvidia gives away $100 billion on paper without any money changing hands, and OpenAI gets a load of graphic cards for their AI processing, again without any money actually changing hands. Neither company is richer than it is before, neither company is actually more valuable than it was before, but OpenAI gets to list $100 billion extra on their assets, and Nvidia lists 10% of a $500 billion company on their assets, and Nvidia then lists an extra $100 billion in revenue on their books as well over the next few years, which is just like what Enron was doing all the while ago as well. Now, Nvidia does have real revenues, real sales, and real profits too. But just like Enron, they're inflating their books with fake revenue that doesn't really exist except on paper and doesn't actually make them a more profitable company. Now, Enron had some real revenues too, some real profits, but more than 50% of what they claimed at the end of the day was fake. And when Nvidia announced their $100 billion deal with OpenAI, they saw their market cap grow by about 11% on the news of this deal alone over the last month, which amounts to about $500 billion in market capitalization or supposed value increase according to the market. Even though Nvidia haven't literally released their report for the last quarter and added $100 billion to their revenues, all from this new OpenAI deal like Enron would have, even though they aren't literally using mark-to-market accounting, the investors who read the press release, they basically interpret Nvidia's revenue as instantly increasing by $100 billion, so they valued the company at an extra $500 billion. So again, there's a very, very distinct relation between what the market interprets as instant revenue on these AI companies and the mark-to-market accounting trick that Enron was using to inflate their value 25 years ago. Again, another dangerous similarity between Enron and these AI companies is the use of deliberately complicated and convoluted deals and subsidiary companies and special purpose vehicles and investments to make the whole thing impossible to really follow and unravel. Now, we know that Enron would literally create smaller companies and then pass them assets and debts and investments to hide them from investors trying to work out the company's true fair value. And we actually see AI companies doing the exact same thing right now. Now, this graph here shows exactly that. It shows all of these circular deals and circular investments between a bunch of these AI companies. Now, Nvidia is obviously the biggest winner of this AI bubble so far, and they're investing into an insane amount of different AI companies, so much that it's impossible to follow. But I'll try and just read this out loud just to make clear how ridiculously convoluted and difficult to follow this really is. So Nvidia invests $100 billion into OpenAI, $5 billion into Intel, $700 million into Nvidia, $6.5 billion into CoreWeave, $1.1 billion into Nscale, and they invest into xAI and Mistral and Figure AI as well. Then OpenAI, well, they invest into Nvidia's biggest rival, AMD and Microsoft, and then Microsoft invest into Nebius as well, and then back into OpenAI. And all of these companies, whilst there is investment being traded between them too, they're all buying services and hardware and software from each other as well. This is impossible to interpret, it's impossible to follow, and no one knows how much of these supposed $1 billion deals actually lead to the growth in the earning potential of these businesses. They're all so brand new that frankly, we have no idea what's going to happen with them, if any of these deals are actually going to come to the market, but the market is basically treating any press release from any A company as if they had literally just accepted a shipment of gold and it's now locked away in the company's vault. And that brings us on to the third really big problem that relates Enron to this AI bubble. And that's the relation between a new technology and the hype and the excitement around that new technology that fed into the frenzy for deal making and investing, despite the fact that when a new technology comes to light, it's almost impossible to know who's actually going to get rich from it and who is going to get poorer from it. Right, Enron grew alongside the dot-com bubble and the telecom bubble. Now, the internet was brand new and it was set to change the world, and it allowed brand new companies like pets.com to suddenly exist when before they were literally inconceivable. And there was a huge amount of hype around the telecoms industry as well. Putting the internet on a phone, that's a brilliant idea. But all of these developments, these technological advancements, they required huge infrastructure works to make all of this feasible. So there was a massive telecom bubble at the exact same time as the dot-com bubble as well. Now, Enron in particular rose off of this hype. It, at the end of the day, was supposed to just be an energy company, but it rebranded itself as a new energy company, which used technology and fast data transfers and the internet to be faster and more efficient and more profitable than the competition and to inflate their value and all of that. And Enron even launched Enron Online in 1999 as an internet-based trading platform, basically like E-Trade was as well, literally jumping on the dot-com hype. Also, Enron was on the other side of the bubble as well, the telecom side as well, expanding outside just energy trading, literally claiming it was now suddenly part of the telecoms industry because it was creating this new product where you could trade bandwidth or like internet service trading, which never really existed. Now, the AI bubble right now is incredibly similar to the dot-com bubble and the telecom bubble of the 2000s, right? And actually, it's ridiculously similar. The dot-com bubble was basically the hype around companies which would use the internet to make more money, whereas the telecom bubble was the hype around companies which would build the infrastructure out for the internet and to run it and make money that way. Today, OpenAI is like the dot-com companies, developing the AI, the software that people actually use and are making money off of it. Whereas Nvidia is like the telecoms companies, building the infrastructure that the AI will actually be built off and making money that way. Both the internet and the AI are brand new technology that no one can really understand truly yet, and no one knew back then what part of the internet was actually going to make people rich. It was obvious that it would change the world, but no one knew which sectors or different industries would be able to capitalize off it. The companies selling access to the internet in the end, the telecoms bubble, turned out to never really make much money at all, whereas the companies using the internet were the ones to actually grow into the trillions. And today, it's the exact same thing with AI, the only exception being we don't know which part of this AI bubble is going to work out in the end and which won't. Right? Maybe OpenAI will never actually really make much money. There are 50 other AIs out there which are basically just as good as ChatGPT, and there's nothing except for branding really to keep ChatGPT ahead of the competition, to be honest. And OpenAI lost $5 billion last year, and the rate of their losses is increasing as well. OpenAI this year are so far spending 15% more to generate just $1 of revenue than they were the year before. So they're getting less efficient over time. So maybe actually making the AI models will never produce much money or value because there's just too much competition. Now that would be backwards to the way the dot-com and the telecom bubble ended up, but again, we just don't know at this point. Or maybe Nvidia will never be able to match the insane deal numbers that it's reporting at the moment. After all, when you are literally selling $100 billion worth of hardware in a single deal, how many potential customers are there? How many times is a company like OpenAI going to need to quintuple their hardware? And what if OpenAI don't make any profit? Why would they continue to buy $100 billion worth of GPUs? Or more importantly, how would they fund that? We do know for sure at this point that AI will change the world and someone will make trillions, maybe even quadrillions of dollars, but we don't really know who that someone is or what they'll actually make the money on, just like the telecoms giants and dot-com companies in 2001. Now, a criticism I've heard a lot is, well, the internet giants did win out in the end, so if I invest in both AI hardware and AI software, or if I'm just in the markets in general, it'll all be fine. As one falls, the other will rise, and it will all cancel itself out. But those people are forgetting the other key characteristic of a bubble. It's not just excitement and hype, it's over-excitement, and it's over-hyped ideas. Yes, Amazon did end up becoming a $1 trillion company, and so did Google and Facebook and all the other companies built on the internet which saw a massive boom during the dot-com bubble ended up actually doing quite well 20 years later. But Amazon, for example, peaked in share price in 2000, and it took them 9 years to beat that share price again and actually become a profitable investment for those who bought in during the bubble. And a company like Yahoo peaked at a value of more than $100 billion during the dot-com bubble, only to be sold for just $4 billion, a 96% loss, literally 22 years later. Now this is a really serious issue, but there is one slightly funny thing that I briefly want to mention talking to you today, because no one is talking about it. And it's the fact that, yes, the fraud of Enron is very similar to the fraud of circular investments and circular deals that we're seeing with these AI companies today. And yes, the technological bubble and the hype around the internet and telecoms industry back then is incredibly similar to the hype around AI and the GPUs that we're seeing today. But funniest of all, is that Enron is actually back right now. It's just 99% of people haven't even noticed. Thankfully, it does seem to be a joke and not a real attempt to start a whole new business. Basically, a t-shirt company bought the Enron trademark and business, they made a new website, and they're now running satire-based social media campaigns to garner up attention and to sell t-shirts. The funny thing about it though, this new owner of Enron understands so perfectly the bubble, the hype, and the fraud of Enron in the past and the environment that we're in today, and he's playing off that similarity for free advertising for his t-shirts. This right here is the Enron egg. True to the energy roots of the company, it's supposedly a tiny little at-home nuclear reactor. Obviously, it's a joke, right? It's not real, but it's the exact same type of technological advancement that would have caused a massive bubble and loads of hype and trillions of dollars in supposed value, and a fraud that would go down in history to top it all off as well. So just like that new AI software that can think and reason better than a human and put us all out of a job. Now, at the end of the day, there really aren't many concrete examples of wealth or value creation from AI so far. Mostly, it's just being used by people who don't want to search through Google results, or students who can't be bothered to do their own homework, and small businesses looking to be about 10% more efficient with their time. And actually, there are a lot of reasons to believe that the efficiency gains from AI are practically negligible. Now, I'm planning on making a video over the next week explaining exactly why I think that. But the applications behind AI so far are pretty underwhelming, and there's clearly a very long way to go. And I know it must be getting a little bit tedious to hear at this point, but that's very similar to the dot-com bubble, right? These internet companies were worth billions despite never really making any money yet. And yes, many of them did go on to make trillions of dollars in the future like Amazon, but it took more than a decade of the market maturing and consumers and producers working out how to use this new technology for the wealth and the value to actually be created. And I am pretty much certain that's exactly what's going to happen with AI over the next few years. These hundreds of billions in revenue, they all come from venture capital funds. OpenAI, right, they raise $10 billion in cash and they use it to buy $10 billion worth of GPUs from Nvidia. Nvidia then invests that $10 billion into CoreWeave, who spend it back at Nvidia, and Nvidia then invests that $10 billion back into OpenAI, who then chuck it into Oracle and spend it back with Nvidia, and so on and so on. All of this supposed revenue and profit isn't coming from customers handing over their credit card details, right? It's coming from a venture capital firm throwing $10 billion of cash into a spider's web of investments and deals that no one can really keep track of. And my hunch is that there isn't much real value here yet, at least. And when the bubble pops, this will all fall apart, and the $20 trillion in the S&P 500 index funds, well, that's all going to disappear as well.